Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at our proxy for the S&P 500, which is the SPY ETF. We're going to be looking at a couple of counts and we're also going to be looking at some basic technical analysis. So we're almost back at new highs, very close to. We did not get a deeper correction, which is one of the options I discussed in the previous video. So we've got two counts to look at. As I said in the previous video, if we did not get a deeper correction and we respected that pitchfork I showed, that trend I showed, then I would consider, I would downgrade all of the labelling to a lower wave degree. Well, I've done that for an alternate count. But before we adopt that more bullish position, which is why I've done it, we have to be prepared to accept that this market's just going to keep pushing higher and higher and higher. We have to also keep in mind that this correction might not be over. This may seem a little misleading to people who are observing bullish moves to new highs, but we have to appreciate that the most common flat patterns are expansive patterns, which have an expansive B wave beyond the previous high and then come down lower. That's actually more common than a regular flat which respects the previous high. And since we had a zigzag in the primary 2, a flat, a longer to more time-consuming wave 4 in a flat pattern is a possibility. Whether or not it's likely, whether or not it's going to happen, we can talk about that. But we will also come and have a look at the revised more bullish count, which says this is still a 3-4 but of a lesser wave degree, which means bull market's going to last longer, bull market's going to go higher. So first things first, I just want to remove the count and show you what I mean by reminding you of that previous pitchfork. Now we don't need them all here, we just need this one. So we spoke about how we'd come down to this level and were we going to respect this level, a bounce, or were we going to break it? Well, we had the idea of a three-wave W with a three-wave X and then a three-wave Y. Not likely now because we're more likely to go to new highs. We could still have an ABC flat instead, which we'll talk about. But we did get a bounce. We came back, tested it. We got 3 separate candles testing the bottom of the pitchfork here, and we've moved higher. So that pitchfork was respected. And of course we've placed this based on our primary pivot back here, which we said was 1, which I believe is still true, and this is 2, which I believe is still true. If this is 3 and 4 at the same primary degree, which I'm not going to dismiss completely, this could be a double zigzag in itself rather than a plain zigzag, but we appear to have a zigzag here as well, so that means no alternation at primary degree, which would be very, very peculiar. Okay, not something I would expect to see. So that's why I suggested that if this pitchfork was respected, we would consider downgrading this, keeping it as a 3-4 but downgrading it to a lesser degree, and that's what we're going to consider. But before we do that, let's come in and consider the possibility that this is a bluff. And there's no better bluff for people who necessarily do not follow or understand these expansive moves if they occur, to fool people into providing more liquidity. Because if there's one thing people will do when they see a market move to new highs is they tend to pile into it. Now, the whole point of the expansive trap of a flat pattern is to literally push beyond the highs to drag in that bullish bet. Now, it could just be an impulse wave and we're going higher, but it could be this. It could be 3, 3, 5 flat, which is more common than respecting the previous highs, that we would actually come above them and then do this 5-wave move. Okay, so we're going to have to come down to, let's bring up the count, come down to a smaller time frame, let's say the hour time frame here. Now, the easiest thing would be to just say 1, 2. Okay, 3 to come, 4, 5, into a larger 1, back into a 2, off we go into a 3, higher and higher, higher. That's the bullish count. That's the revised wave degree count. But the bearish count, and the reason why I think it's still got some legs, some possibility, is we appear to have 3-wave move here into an A. Right, we've got this B. Now this could be W, X, Y, right? So this could be a zigzag, this could be a B, and this could be a zigzag, correct? With 1, 2, 3, 4, 5 here maybe, and then maybe a small C, I'm not quite sure. So we could label this WXY, and that would provide alternation at a greater wave degree, but I think that's a bit of a stretch. So I'm just going to say ABC. Now, off of this low, assuming this is the low, we get a free wave move. Now, there's no kidding yourself or lying to yourself. It doesn't matter whether you look at this on the ES1, whether you look at this here on the SPY, or whether you look at this on the SPX. This is not 5 waves. No way in hell is that 5 waves. This is 3 waves all day. Okay, so in order for the balls to be right, this is a truncated low. And this is 1, 2, 3, 4, 5 into here, and this is 3 back. So this is 1, this is 2, and then they're right. But a truncation seems a little rare. It is rare. It seems a bit odd. Now, I'm not saying it's impossible, but it's more likely that this is 3 and not 5. Okay. Now, that doesn't necessarily mean that this isn't impulsive, that this isn't a motive. Well, it means that it's not impulsive. It's not an impulse wave, but it could be a wave 5 still. Okay, if this was a 3, this was a 4, the first move could be 3 waves into a 1 for a diagonal, correct? With a 3 waves into a 2, and then some kind of 3 waves into a 3, and then some kind of 3 waves into a 4, you get the idea. So, we can't dismiss the bullish case just because of a 3 wave move. This is what makes these things incredibly tricky at times. This is why, as I pointed out to our patrons, and in the Elliott wave series that I created, plus also the other trading videos, this is why we prefer to trade wave 3s of 3s. Yes, we'll trade a wave 3 and a wave 1 or a wave 5, but the 3 in the 1, the 3 and the 5 will always subdivide as a pure impulse. Whereas the 5th wave of the 1, the 5th wave of the 3, and the 5th wave of the 5th, same with the 1st of the 1st, the 1st of the 3rd, and the 1st of the 5th, can all potentially divide as diagonals and therefore potentially give you this 3 wave move into a 1. This can be misleading, especially when we're in a circumstance where we've had 3 already and now perhaps are having 3 now before reversing in a larger correction. All these things add to confusion. So the first point I would make, which is making me lean, I think, slightly more bullishly, is the sheer respect for that low. We've had a significant bounce off of it, and we had significant test of a long-term trend, and then we rocketed. This is nothing new. We've been doing this for months and months now. So, what I've got up here are a bunch of targets, wave B targets I put up here. This is a green box, and this blue line represents the 123.6% expansion of this A move. The green line represents the 131.8% expansion of it, and the yellow line represents the 161.8% expansion. So traditionally we could say a 3 wave move here back to all-time highs or 90% of all-time highs. Now we've already come past the 90%, so we could come to all-time highs or just beyond it, and then we could turn down into 5 waves. If we go beyond 100%, then this is your box. This is the likely turnaround point, somewhere between the 123.6 and the 161.8. So we'd come up in here in 3 waves and then come down in 5. That would be the bearish case. Okay, now here's an issue with it. The issue I've got is if I take this projection is fine, but if I take the length of our proposed 3 wave move into an A, the length of our proposed 3 wave move into a B of our B leg, then the maximum extension from which, if we go beyond, we should become extremely suspicious that we're looking at a 3 rather than a C, is a 1.618. And what do we notice about that extension? It does not make it into this box. Okay, it doesn't expand into where we'd expect to see the completed B wave. Now it could reverse here. Fair enough. I've already said that. If you come back above the highs, 90% to any time above the highs, we can reverse. Okay, so this would be the first target, a 1.618 extension of the A, but we're already pushing. We're already pushing the wave C expansion at this point. 1-to-1 parity would have been normal. Any longer starts to become less likely. Now, if we go beyond the 1618, then it's more likely that this was a 1, and this was a 2, and this is a 3. Now, the 3 does appear to be impulsive from a bullish perspective. 1, 2, perhaps this will be 3, 4, right? Dividing as an impulse, which we would always expect to see in a 3, whereas we had this 3-wave move in a 1, or an A in this case. Could there be another argument here for another expansive B from a different pivot? Yes, and this is once again adding further complexity. So what if, and we're going to consider all of these things before we move into the bullish count, what if this is the correction here, and this is A, okay, and this is B? So we get an expanding B wave on the lows, 3-wave move, 3-wave move, perhaps, and then now 1, 2, diagonal, 3, 4, 5 into the C. You see how tricky this can get? So if this is an A over here, that means we'd have to revise where we'd find our expansive pattern. So now let's take that here. Now what you can see here is the targets are ever so slight, just slightly lower. Here's a blue one, here's a green one, and here's a yellow one. So we're roughly in the same box there. But what about our expansive move for our C? What does that bring us? Okay, and that's what we're going to have to look at now. This will be different also. So we take the length of the A, we come down to the C, and then what do we see? Here's the 1.618. So we are right on it at the moment as I speak to you. That's where we closed. So this is an alternate B wave target. Now, the most important question there is, did we retrace 90% of this move down? Yes. Here's 89%. We've done enough for a regular flat as well. So ain't that great? So now we've got the possibility of a reversal around this 1, 2, 3, 4 little candles we've got on the 2-hour chart. So there's resistance here. Now, it may look like there's just nothing here to stop us from a traditional point of view, but there's always something, and it's this 1.618 that's waiting up here. So reversal from here, there's your flat pattern. This is A here, this would be B, and this would be C. Right? And that's it. That's the bearish possibilities. I would argue, go beyond this level. Let's pop a price on it. Go beyond 456 spot 69. Go beyond this, then these targets are unlikely anyway. I was just pointing out the traditional targets for a B wave expansion. But given the circumstance of this being more than a 1.618 extension of the C wave, I find that unlikely. So go beyond this, and I think you've got to lead more bullishly. And I think you've got to interpret the move more bullishly. If we get reversal signals here or here, rollover of momentum, extreme overbought conditions, divergence between two highs on a smaller time frame, and you know what I'm talking about. We talk about the reversal conditions all the time. If you see that, and then we start to impulse down, this could be a 1, this could be a 2, and we work our way down in that C, and everyone gets caught out. We make new high, we either stop just before the highs, or we make slightly higher highs, drawing in liquidity from the breakout traders who like to, you know, for some reason that I will never understand. Rather than buying here, they prefer to buy here. It just seems crazy to me. But whatever, that's just the way some people work. Draw in the liquidity, trap them up here, and then shit on their heads. Okay, not saying it's going to happen, but the possibility's there. It's all set up, and it's possible. Alright, so that's the bearish count. If your head's spinning and you're like, well, that's great, I'm none the wiser. Well, welcome to 2021 S&P 500 index. This is just the way things are at the moment. We have this constant underlying bid, which won't allow deeper corrections, and therefore keeps extending smaller wave degrees, making these smaller corrections the only buying opportunities in the market. And then they get brought up, and we get these conflicting patterns, because we don't have a nice clean hammer blow of a correction to break the chart. And then once you get that, and it will come, once you get that, you get far better idea of where the hell you are in time and space. In the meantime, you just got to do your best with what's become a very convoluted and difficult count. So on that basis, let's leave the bearish count behind now, and let's consider a far, far, far simpler scenario. Okay, I'm just going to save these first and have these as wave B targets 2 because I think they're more relevant, as I discussed. We'll do a summing up at the end of the video. So let's now move on to an alternate count. Now I haven't had time to fully flesh this out. Bear with me. Wave 3 extension, I'm calling it. Let's zoom out to the day time frame so we can make better sense of this. Now I haven't labelled it all. I'm still, like I said, I would only relabel once we saw this pitchfork get respected, and it did. So I went off and relabeled. Right then. So the first thing you'll notice is we still have the same 1-2 pivot. I don't think there's any need to change that. This is an initial move up, significant move up off of a major collapse, and this is our first significant move since that low in March 2020. So this should always be labelled 1-2. And if we're going to assume an extension, we start with the larger degree and then move into the smaller degree. So we have to assume that the most common extension will be in a wave 3. And therefore we label higher degree, lower degree, lower degree, so on and so forth. Okay, and that's how we work our way up into a wave 3 extension. If you don't know about how extensions work, there's a video about Elliott wave extensions on the education channel on the Discord and also on the Patreon. Right then, so keeping it super simple, we've still got a 3 and a 4. But it's now a minor wave degree rather than primary, and it's not even intermediate. So I figured if we're going to be bullish, let's be bullish. Yeah, if we're going to give a bullish scenario, let's give the bulls some credit, because let's be honest, doesn't matter how much you want to talk about macroeconomics, or you want to talk about money printing, or you want to talk about reckless monetary policy or anything like that, the bulls have been right, flat out, completely right, and I've been bearish on multiple occasions and I've been wrong. Okay, now it's a good job I remain invested in the stock markets and I provide my monthly dividend calendar and stock investments, because this has kept me in the running even though my opinion has flip-flopped on occasion. But that's just technical analysis, it's just the way it is. Okay, so let's just delete that. I don't think we need that. If we do, we'll bring it back in a minute. So the idea here is that we are actually going to achieve an extension in a primary 3, which means we have to get beyond the 100% of the length of 1 and look for likely extension targets, the most likely being the 161.8. That's why I had that up there, plonker. So let's just pop it back on. Now I'm sorry this is taking a long time, but I wanted to be thorough. Okay, we came up very close to the 100% but didn't make it. This was a potential target, and off the idea that this was a primary 3, we would have a limit on the primary 5. If we make new highs and go beyond this target, then those restrictions for a primary 3 are gone, and the more likely conclusion is up here at the 1618. So here's the primary 3. Now don't worry about all these numbers, these are just waiting up here ready for me to place them, but the primary 3 would be somewhere between the 123.6, which is roughly around 493, so 4,930 on the SPX, all the way up to about 5,450 on the SPX, and anywhere in between. But if we came to the 1618, which is the most likely target for an extended wave 3, then we've got I was about to swear, we've got a long way ahead of us, way out into next year or further, just to complete the wave 3. Okay, in order to get up here. Now, it's all about the speed you get up here. If this is 3, 4 at minor degree, then we've got to go 3, 4 intermediate degree to get the 5 of the 3. Do you see what I'm saying? So it's still early days. So from that point of view, we've gone 1, 2, 1, 2, 1, 2 at minor degree here, 3, 4 at minor degree here, 5 to come sometime soon into intermediate 3, then a bigger, more time-consuming correction into 4, up into 5 to get this 3. That's it. That's the bullish count. And we'll see how things develop, but if we don't get a reversal around the highs now, using this free wave expansion to this pivot or the slightly lower pivot for an expanding an expansive B. If we don't get a reversal around any of these targets, we don't get a shift in momentum to bearish conditions, and we don't get a flush down and an impulse, if none of those things happen, and we break those levels and continue higher, this is the likely correct count, and this is the one that will become our primary, and we'll start working with this instead. And I think the one thing that seems to be holding steady the whole time is this initial pivot off of the 1 and the 2. So over the longer term, just observe this. It's been tested significantly for the first time since October, November last year, and it's held. For as long as this pitchfork holds off of this 1-2 pivot, I see no reason why we won't just continue working our way up to this target. Here's the 1618, here's the 123.6, here's the 130.18 extensions for a primary wave 3. And look how much room you've got in here. 1, 2, 3, 4, 5. You could do it no problem. Okay, obviously you stop for a 5 into the 3, and then you'd have another 5 into a 4, could be over here, then you'd have another 5 waves up. But if this pivot holds, and this pitchfork holds, and this is what the algos are trading within, and will continue to do so, then you can see how you can easily work your way up to here. It just takes time. It's all you need. You just need time, and it can work its way up here. So that's the bullish count. Like I said, if there's no signs of a reversal, and there's no shift in momentum, and none of those wave B expansive targets hold, then this is the count that's going to take precedent, and that's why we don't get emotionally attached to things. You know, because it doesn't matter what our view is, the market doesn't care what our view is. You know, so at the end of the day, I think this is kind of similar to, you know, just the inflation of markets in general at the moment. The bulls are right in most places. Now, thankfully, I'm being very right at the moment in crypto, and it's rewarding me, but I don't have a time machine. If I did, I'd go back here to March 2020 and just throw a lot of money at the market. I'm not as exposed to the stock market, US stock market, as I would like to be. I still have a lot of stock exposure, but I'm a bit more picky with what I will buy. So there's that at least. But yeah, if you manage to do that and you've been enjoying this bullish rally the whole time, don't listen to the constant naysayers, because you're right, and you've been right up until this point, and you're right up until you're wrong. And until this trend breaks, until this pitchfork breaks down, until we get reversal conditions on a larger wave degree, you are going to remain to be right. And therefore, that's that. So let's do some basic technical analysis now before we wrap up the video. Okay, let's come on to the weekly time frame. Have I got that longer term count switched on? Or no, I've got it off. That's fine. Okay, so let's turn them both off actually. Oh no, sorry, let's do wave 3 extension up here, excuse me. Right then, excuse me. Let's bring up our moving averages, exponential moving averages. Should we have a volume profile on as well? There's nothing really significant here to look at. Bring up our momentum indicators. That needs to be dragged back down. Get rid of our favourites bar here. Okay. So we came down to the 20 exponential moving average on the weekly time frame, and we wicked through it. Wick here, bodied 2 candles above it, and then this candle bodied more vigorously above it. The intraday price action broke it again, and then we got one more wick here. We would not body the candle below, and then once again we've had this strong bullish engulfing candle here, and then we've continued higher. So very strong increase in bullish momentum here over the last few weeks since testing the 20. There's no doubt about that. Okay, so RSI, let's have a look. So currently we have bearish divergence between previous highs and current price action. I say that given the assumption we'll make new highs. You mustn't take that as rote. I just think it will happen. I think we will likely make new highs, but if we don't, then there is no divergence yet, because we have yet to make a new high in price. If we do make a new high in price, then the best we can say is that there is bearish divergence between previous highs and current PA, current price action, not a current high. I must point this out because I see people often in comment sections and elsewhere say, oh, that's bearish divergence. It's not bearish divergence until you're looking at two highs. If you're looking at current price action and the previous high, it's just bearish divergence between the previous high and current price action. And until you get a reversal, it doesn't mean anything. Okay, it's just a potential warning of what may occur. Once you've got an actual reversal in place and divergence between two highs, then you can use it as evidence for a bearish case. That does not yet exist. Okay, not technically. Now on the weekly time frame, we did not get back down to the zero bound on the MACD anywhere near it yet. We will when the day finally comes to correct all of this move, but that could be a long way off yet. The average is starting to curve back up, drop off from bearish momentum, some lighter coloured candles, lighter coloured bars here on the histogram, getting close to cross over the signal to the upside. So we'll see if that plays out over the next week or so. Let's come down to the daily time frame. On the daily, we broke the 60 exponential moving average with price closing below for the first time since September and October last year, which unsurprisingly formed the initial pivot of that pitchfork. We came back below the 10, the 20 and the 60 to test the bottom of that pitchfork, the first significant break in momentum, the first significant break in the moving averages for a year. So there you go, that makes sense. We were expecting something bigger, it has yet to occur, could still occur if that bearish count is correct, but no signs of it yet. Like I said, strong bullish momentum. We moved down below the zero bound for the first time since we didn't even manage it in May. It was a year ago, pretty much, again back in that September-October period. So moved down below the zero bound, cross of the average over the signal, build up a bearish momentum. Now a return to bullish conditions in momentum, brighter green bars in the histogram. The average crossing over the signal, both lines pushing back above the zero bound and separating and expanding away from one another as we move higher. We've gone from overbought to oversold conditions on the daily time frame on the RSI. A round trip, as I like to call it. So here, bum, 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 to here. Big bullish move. So we've done, now it's not a technical condition or rule in any way, but we like to see overbought to oversold, especially when we have this build up of divergence prior to a correction. This high, lower high, lower high, bearish divergence over a sustained period of time, correction to oversold conditions, new move up, RSI reset. Okay, the only way this could get worse or break down further would be if that bearish count is correct and we come down to a much lower level, push into deeper oversold conditions. But there's no reason yet to suspect that's going to be the case. Not until we see something significant happen up here, and we'd be looking for a significant bearish candle on the daily close and the weekly close as well. We'd be looking for reversal of momentum conditions. We'd be looking for an impulsive move down and a free wave move back. We'd be looking for an increase in volume to the sell side. All these things are trying to establish a top. Okay, right, so that's the basic technical analysis. Speaking of volume, I think we had, the drop off in volume all the way during this divergence that we saw in the RSI, that we've seen in the MACD from the high here to the lower high here. Excuse me. And then we saw the crescendo of the selling pressure in the volume here. And now we're entered another phase where we've got declining volume again. This could carry on for months. We've seen this market move higher time and time and time and time again. Just like this huge move here. Seen it done on very low volume. There's no reason why that trend can't continue, and we continue to push higher on low volume. Alright then, that's all I've got for you now on the SPY. If you're new to the channel, if you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And thank you, as always, to my patrons. Your support is greatly appreciated. If you're interested in joining the Patreon, there's a link in the description below. You can head over, have a read of the different tiers. I would suggest that you leave it until the start of a new month, as there's only a few days left now in this month, and you will be charged the day you sign up and the first of every month thereafter. Okay, so you'd only be getting 10 days worth of value for your initial fee. So I always encourage people to just wait for the start of the new month so they get maximum value from it. But over there you've got so much educational content to go through, it's ridiculous. But either way, thank you for joining me. I hope this has been helpful. Can't guarantee that it has been, but we'll see how things progress. If I had to hang my cap on something for the moment, and I don't like to stick my neck out when I'm not sure, I'm leaning towards the bullish revised count purely because of the underlying strength of this market is phenomenal and has proven bears and myself when I've been bearish to just be flat out wrong. So until I see something more convincing, I don't see why you should not be fighting the trend, should you? So now I could be coming back with egg on my face for a second time in a week's time, because we could be back below these lows and we could have had that expanding flat play out, but at least I've given the option of it being technically possible. Alright guys, take care and I'll be back with you soon. All the best. Bye bye.